Hi, I'm Victor Adair, and I'm here on behalf of HowStreet.com. We're in Vancouver. It's the second week of June. We've had some great developments in the markets, and we're here with a longtime friend of mine, Bob Hoye. Bob, good to see you.
Good to be here.
Bob, you are the editor-in-chief at Institutional Advisors. I've been reading your reports for years and years. Going back almost 2 years ago, you were calling the crash in the markets using like an analog to previous markets back, 100 years ago, 200 years ago, and that sort of thing. Lately, we've seen, let's call it the relief rally, the green shoots rally,
Yes.
or something like that. That by lately, I mean the last 3 months or so. What do you make of that?
Okay, that was on schedule. We had the crash last fall, was replicated 1929 almost to the day, and then you'd get the big bounce out to around April or May, which is what we have. And this was to reach, let's call it, the speculation is just as speculative as ever, and then as the barons noted on the same move in 1930, they said that it would be difficult to quench the fires of enthusiasm. Well, I think they've just about run out.
So we've had a lot of enthusiasm in the markets here. I think a lot of people may have thought, okay, we've had the government step up, we've had the authorities step up, they've prevented the worst possible from happening, and it's on to bigger and better from here. I know you don't agree. We're going to do a short interview. Tell me, what do you think lies ahead here?
Okay. One of the things that happens with this is that as the stock market goes up, the establishment got very excited, as in 1930, and forecast that the economy would turn up late in the year. Then the stock market failed, but the key thing is that on Friday, the short rates went up quite alarmingly. Like the 2-year note, which was trading at 0.96%, jumped to 131, and then short rates have continued to rise this week. We should note also that beginning the first of the year, long rates in the U.S. soared from 2.5% to recently 4.60, and now you're getting a rise in short rates. I think the rise in short rates is indicating the beginning of the next contraction.
I mentioned Bob Hoye and its Institutional Advisors, the website institutionaladvisors.com. Go there, get a free trial subscription to the letter that Bob writes that is received by traders and investors all over the world. I know you'll look at a number of signposts, the relative changes in the yield curve, and now this blip up in short-term rates. But another one that I know you pay attention to is the gold-silver ratio.
Oh.
What do you tell us about that?
Yeah, that's a good one, Victor, because it, in a boom, goes down, and it went, and then in a crash, it heads up. And on the crash last fall, it got as high as 88, as silver fell relative to gold. And then last week and down into Thursday, it came down to 61, which was quite a move. And then in the last few trading days, it's gone up. It's up to 63.5. Victor, this is a confirmation that there's a change in the credit spreads coming, and then we're back into another phase of the train wreck in the credit markets.
One of the things I've noticed is that despite whatever market you're in, whether it's currencies, whether it's stock markets, whether it's credit or commodities, what have you, the last few months there seems to have been a willingness to take on risk. People have gone out, say, bought the Mexican peso against the US dollar for one idea. They've been buying commodities. There's been some enthusiasm there. We've been looking for some signposts that we're going to make a top and turn lower. Mm-hmm. I guess the question on a lot of people's mind, especially with regard to stocks, we made some tremendous lows back around the end of February or so. Are we going to make new lows?
Yes. Yeah. One of the other things that we're looking at is the overbought we got in some commodities, overbought in some stock indexes, and the tremendous oversold in the US dollar. The bear raid in the US dollar was back on again. We've got global forecasters calling for hyperinflation in the US dollar. We think not, because there's too many people have been long the hot stories and short dollars, and with this we expect the interest rates to change and the US dollar to firm against most commodities and most other currencies for most of the time.
We've been talking with Bob Hoye. Bob, I mentioned, a longtime friend of mine, the editor of Institutional Advisors, the services that come out. And by the way, with that, one of the pieces that I really like are the chart works, where your technical people give you some very specific recommendations. So take a look at institutionaladvisors.com, get yourself a free copy. And do yourself a favor, pay attention to what Bob Hoye has to say. I'm Victor Adair. On behalf of HouseStreet.com, I want to say, Bob, thanks for being with us today.
Very good to be here.
We'll see you again soon, I hope.
Yeah.
Comments made on House Street Video and HouseStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HouseStreet.com. House Street Video is a production of House Street Media Incorporated.